How interest rates affect inflation and the economy. Interest rates are the amount of money owed on a loan, or the amount of interest paid. Interest rates are determined by how much people will borrow and what they will pay for it. Interest rates affect many aspects of our economy, and they change often. In this article we're going to explore how interest rates impact various aspects of our economy such as inflation, how much prices go up, unemployment, the number of people without jobs, and recessions, a severe economic decline. How interest rates affect inflation and the economy. Interest rates play a big role in how inflation and the economy work together. When interest rates are low, people tend to borrow more money to buy things, which drives up prices. This can make it harder for people to afford their bills and could lead to a recession. Conversely, when interest rates are high, people are less likely to borrow money and spend it on things. This can lead to less demand for goods, which could lead to a recession. Pros and cons of an economic recession. When the economy experiences a recession, people may lose their jobs and money may become harder to come by. This can lead to lower wages, fewer job opportunities, and a decrease in the amount of goods and services available for purchase. On the other hand, an economic recession can also cause people to save more money because they fear that their standard of living will decline even further. This can lead to an increase in the amount of money available for investment, which can boost the economy overall. In short, an economic recession has both positive and negative effects on the economy as a whole. Economic recession timeline. In this blog section, we will be discussing the different stages of the economic recession and how interest rates are related to each stage. The following is a timeline of the economic recession with corresponding interest rates and inflation. The following is a timeline of the current economic recession. This timeline is based on data from the National Bureau of Economic Research. 2001 to 2007, a time of strong economic growth and low inflation. 2008-2009, the economy experiences a sharp decline, and inflation falls below the Federal Reserve's target rate. 2010 to 2014, the economy slowly recovers, with modest inflation above the target rate. 2015–present, the economy experiences another sharp decline, leading to an increase in inflation and a recession. What causes an economic recession? The following is a timeline of the current economic recession. This timeline is based on data from the National Bureau of Economic Research. 2001 to 2007, a time of strong economic growth and low inflation. 2008–2009, the economy experiences a sharp decline, and inflation falls below the Federal Reserve's target rate. 2010 to 2014, the economy slowly recovers, with modest inflation above the target rate. 2015–present, the economy experiences another sharp decline, leading to an increase in inflation and a recession. Steps the Fed take to reduce inflation. The Federal Reserve has a number of tools it can use to reduce inflation, including raising or lowering interest rates. Interest rates affect the cost of borrowing money, and can influence both consumer and business spending. When interest rates are high, people and businesses have to pay a lot for loans, which can lead to decreased spending. On the other hand, when interest rates are low, people and businesses can borrow more easily, which can lead to increased spending. The Fed uses a variety of methods to decide on the appropriate interest rate, including looking at inflation data and economic indicators. How are interest rates calculated? Interest rates affect inflation and the economy in many ways. Here is a look at how interest rates affect inflation and the economy. When interest rates are high, it can make it more difficult for people to borrow money. This can lead to a decrease in consumer spending, which in turn can lead to a decrease in the overall economy. Low interest rates also tend to increase inflation. This is because they make it more affordable for people to borrow money, which in turn causes people to spend more money. Higher inflation can cause problems for the economy, because it makes it harder for people to afford goods and services. Inflation is a general increase in prices and it's measured by the Consumer Price Index, CPI. The CPI is calculated by taking the average of prices of a group of items. When the Federal Reserve increases interest rates, it causes inflation to decrease. This is because when interest rates are raised, it makes borrowing money more expensive. This makes people less likely to spend money on items that are inflationary, like cars and homes. Inflation has a negative effect on the economy because it makes people less able to afford their debts. When people have to pay back more money than they borrowed, they have less money left to spend in the economy. However, there are also some benefits to high interest rates. Higher interest rates make it harder for people to borrow money, and they can lead to a recession if people can't afford to buy things or invest in businesses. It's important to weigh these benefits and consequences before making any decisions about interest rates. Interest rates are determined by a number of factors, including the federal funds rate, the London Interbank Offered Rate, and the overnight interest rate. The federal funds rate is the primary interest rate used in the United States. It is based on short-term borrowing rates offered by banks within the Federal Reserve System. The London Interbank Offered Rate, LIBOR, is a benchmark for borrowing costs between banks in London. The overnight interest rate is an interest rate charged on deposits that are secured overnight. Thanks for watching. See you on the next episode.